हाँ अशोक.
Good afternoon. Good afternoon, all. To all the respected seniors and my dear colleagues. I see Ashok Ginoria, moderator for today's session. Welcome you all for this session on accounting and auditing implications of COVID-19. First of all, I would like to thank CA Anil Kumar Yadav ji, Chairman Jaipur Branch, CA Kuldeep Gupta ji, Secretary Jaipur Branch, CA Lokesh Kasar ji, Young Member Committee Chairman and immediate past Chairman Jaipur Branch, CA Akash Bargoti ji, Vice Chairman Jaipur Branch, CA Sachin Kumar ji, Regional Council Member, for organizing these knowledge sharing sessions for professional growth. Before going ahead with the session, I would like to welcome our Honorable Chairman, CA Anil Kumar Yadav ji, for welcome speech.
Thank you, Ashokji. Thank you so much. Very good evening to all of you. I see Anil Kumar Yadav, Chairman of Jaipur Branch. Welcome you all in today's sessions of COVID-19 accounting and auditing implication. Friends, today we have very eminent speaker with us, Dr. Devesh Prakash sir. Sir, we welcome you in this session and thanks for your kind concern for Jaipur member. Thank you so much, sir. Friends, today we have also our regional council member, C. Sachin Jain ji. Sachin ji, welcome,
Namaskar,
sir.
Thank you.
We are also with us, C. Lokesh Kasar, sir, just our immediate past chairman and my friend. Welcome, Kasar, sir. Thank you so much.
Thank you.
And now, without wasting time, I request Ashok ji, please continue further.
Yes, sir. So as we all are very well aware about the pandemic virus COVID-19, which is impacting global economy on a large scale. So today's session, we will cover how COVID-19 is going to impact accounting and auditing of the businesses going forward. For a brief session on this, I would like to invite Dr. Devesh Prakash ji. He is CPA US CMA MBA. He is partner EY in Financial Accounting Advisory Services. I would like to welcome him to share his valuable knowledge with us. I request Dr. Devesh Prakash ji to take over the session.
Thanks, Ashokji. First of all, many thanks for inviting me on this session and address to August gathering of the members of Institute of Chartered Accountants, and I'm really delighted to talk about this subject, although this subject is relatively linked with first of all health, and then it became an economic substance, and anything which impacts economics ultimately leads to accounting and auditing, and which is why I believe this session is very dated in the subject, in the context today is very current and very relevant for all the, and I grapple with the situation, and with that I will talking about the background why we have today, and I believe everybody knows the issue that we are dealing with. As I mentioned initially, it started with health issue, resulted into huge economic issue, and as on date, close to over 3 million people have been infected by this, and in India, as we are speaking, we have more than 31,500 cases, and it has led to disruption and uncertainty to individuals, families, and business and economy, and it has created health and safety of the personnel issue. It has resulted in shutdown in the production activity, disruption in supply chains, inability to raise finance, and increased volatility. And ultimately, a lot of people are working from home. These shutdowns has raised the concern on the cyber security, and ultimately, government of India has also announced a lot of measures to take care of it. So I guess presently, as we are speaking, this is a very topical subject to talk about, especially the fact that currently everybody is dealing with this, and especially for India perspective, it has a different implication from the perspective that all other countries in the world are actually following. Most of the countries follow the calendar year, and for that their year end has happened, and for them the current quarter will be quarter one. So it is a quarter one issue for them, but for the India, because we follow the fiscal year, and accordingly it is for us an year end issue. So and which further complicates the subject from the accounting and auditing perspective. So, and which is why it is very topical to talk about the COVID-19 impact and implication, especially on the accounting and auditing.
So Devesh sir, uh, there are some common questions running in mind of every accounting and auditing professionals. So I want you to answer them. So
Sure.
yeah, so the first question that goes in the mind is, uh, can you tell us some macro implications of the COVID-19?
Yeah, certainly. I mean, Ashokji, I think you have raised a very important and question, because before getting into accounting and auditing implication, I guess we need to also understand the perspective from the economy perspective, because ultimately it is the economics which is driving this change in the accounting and auditing world. So certainly I will talk about its implication from accounting and auditing perspective. Uh, so if you look at it, and maybe most of you have heard this concept of the health outcome driving the economic recovery. Everybody is talking about the economic recovery, and the common word which is buzzing around the world, whether the recovery will be in V shape, U shape, or W shape, or a L shape. So I will just try to explain you. Maybe you have heard these words, and what does that mean from the economy perspective. So as you can see, there is a graph which is the macroeconomic effects, which is primarily talking about the GDP growth with a time scale. So suddenly there are actually three graphs in this. The one graph which is actually dropping down, and ultimately it is going flat. So that is generally a L-shaped curve. This is a very pessimistic view about the economic growth, which means that the recovery will take much longer period of time, whereas the other curve, which is primarily U or W curve, which is the second curve, if you look at it, it is dropping down, and then it is forming a wave of the recovery, which primarily could be a U curve or a W curve. And the third one, which is dropping down and coming back very sharply, which is primarily the V-shaped curve. And I think all the people who are all the people who are talking from the positive perspective are actually thinking about the economic recovery will be in the V shape, and ultimately this will certainly impact the businesses, and we will have a sharper recovery phase in the time to come. So I guess we all understand this U shape, V shape, and W shape, but I think it has accounting and auditing implication as well, because while we are making all the assessment with respect to impairment or the going concern perspective, all these economic recovery drivers and the drives will certainly impact the accounting and auditing consideration. The other important point I would want to talk about is there will be a complete shift, and there will be a complete new normal, which is adopting the new social contract and the potential huge changes in the consumer behavior and consumer preference. There will be a greater role for the government with respect to higher tax and leading to people to spend more, and at least initially government has a greater role to play here, and which is what we are seeing in European and American economy. A lot of SOPs have been given, and our Indian government has also given a lot of concessions and has come up with a lot of SOPs, including RBI, etc., wherein they gave a lot of concession to corporates and other players in the economy, and certainly we will see much more coming up in time to come. And ultimately, there will be a complete new business model demand, and climate change will also have some implications. So from the business perspective, I think it will all depend upon the industry a particular business is belonging to, and accordingly it will certainly improve or in the time frame to come. Coming back on the global macroeconomy, as Ashokji asked this question, so if you look at it from the November baseline or February baseline, we see a lot of economies are actually showing a much more negative trend from the current baseline. So you can see the November baseline was very positive, as opposed to Feb baseline, which is little bit lesser in than the November. But if you look at the current baseline, which is in yellow color, it is primarily in negative zone in all the economies. And initially, the US and Eurozones are certainly which are the worst impacted in this pandemic environment. From India perspective, I think the previous forecast from IMF was 5.8% growth. It is now reduced to 1.9. There are various other rating agencies which have done these changes, and ultimately, if we look at Fitch rating, it was 5.6, reduced to 2, pretty much almost in line with IMF. Moody is also in the same line. S&P has given 5.7, reduced to 1.8. Oxford and Goldman Sachs have actually reduced the growth forecast from 6 and 3% to actually Oxford Economics has reduced it to even negative. So I guess there are a few pessimistic and few realistic forecasts done by various agency and institution, but by and large, what we see is that most of the rating agencies have actually come up with the downfall in forecast close to about 4% in the GDP growth rate in the for the fiscal year, and accordingly, FICCI has also conducted a survey of about 317 companies, wherein they found that 53% indicated the marked impact on the business operation even at the early stage, and 80% experienced decrease in cash flow, and close to about 66% felt big reduction in the order book, and 63 cited reduction in supply chain. So I guess these are all the realistic pictures that we have got from the industry leaders from the perspective of what we see the macroeconomic trend of the economy and as a whole from the global perspective, and India in specific. I also want to talk about there is for humans there is a COVID-19, but I think for economy it is financial COVID. So see, the financial COVID has actually impacted the economy the worst in the coming time. I have picked up a few news reports without giving names, etc. But we have seen a lot of, especially in last week, a lot of airline companies on a global footprint have come up and filed the bankruptcy. We have seen a couple of mutual funds closing their debt fund, and that will have serious implication from the accounting perspective. Whichever company we are doing the accounting and auditing, and if they have in those companies have invested in the mutual fund which is closed, certainly the liquidity level has gone down. Even though the NAV will have a number, but at the end of the day, debt fund closed down would primarily mean that the company will not be, or the investor will not be take out their money until the fund is open. So in that sense, it will certainly impact the accounting and implication for that. And it has resulted into some malpractice as well. We have seen one company underreporting the debt by 3.5 times. And lot of reports we are seeing, if despite government making enough announcement in terms of avoiding the layoffs, but still in newspapers we see a lot of layoffs getting planned by the company. So certainly some impact on from the financial COVID as such. And on the right side, if you look at it, I have uh, indicated the industry which are expected to rebound the fastest versus the slowest. So I guess the fastest and then the quickest recovery is expected in medical and pharma sector, food processing and retail, followed by personal and healthcare. Telcos, as it is, are doing pretty well. Even in the lockdown scenario, their demand is going up. And then as we move closer to the quickest to slowest, then e-commerce, agriculture, oil and gas, education, financial services, and from slowest perspective, it will be in the environment of the social distancing. Tourism and leisure will be the most slowest expected, including the aviation sector. Automobile is a mixed response between four-wheelers and two-wheelers. What we expect is two-wheelers will have faster recovery as compared to four-wheelers. So this is the decode EFC analysis in terms of which sectors we are expecting the fastest or the quickest recovery from that perspective. So that is something which from the accounting and auditing perspective we need to take care.
So, Deveshji, these seems like a very big impact on the economy overall. You must be talking to various leaders also. So, what you are hearing from them?
Yeah, that's very also pertinent question, Ashokji. And the thing is, we have been interacting in the COVID environment with a lot of industry leaders, and also what we are doing is we have ourselves conducted survey in terms of how the industry leaders are actually thinking about the environment. And I think that will certainly impact us, and also it will have accounting and auditing implication in terms of how do we see the business growth coming up. So from that perspective, if we look at it, certainly what we have seen is there are various business leaders which we have talked to, or where we have conducted the survey. What we have seen is uh, the critical challenges that each of those business leaders are talking about at this moment is cash flow and liquidity. So this is on the top of mind for all the business leaders, and this is undoubtedly the most critical area which we see will get impacted. Then especially the companies which are dealing with a lot of supply chain, that is also come out as one of the critical issue. And this, apart from the cash flow, the second most area which is very critical from the industry leader perspective is the revenue demand uncertainty. Close to about 32% of them were said that revenue and demand uncertainty is something which is causing little bit of concern in terms of how the consumer demand and consumer preference will take shape, and how will it impact, and what will be the implication for their particular company or industry on a go forward basis once we go on to recovery path. So I guess if we look at it, we can bifurcate the entire problem into three buckets, which is now, next, and beyond. So now is certainly cash flow. Next is revenue, which is people are thinking once the lockdown is over, uh, immediately after that, how will be the demand shape up in time to come. And then on the beyond perspective, how will they take care of the situation, considering that current scenario is little pessimistic at this moment, considering lockdown. A lot of businesses are having almost zero revenue at this moment, except for the ones which are in the essential goods zone. Other than that, almost the business is come down to zero, especially in the lockdown scenario. So what we have seen is close to 80% of the business leader feel that the cash flow and demand uncertainty are the most critical and current challenges in their which their organizations are facing. 76% of the business leaders have viewed cash availability is only available only for the 3 months, which is, I guess, from the growing concern perspective, from the audit mindset perspective, we need to be a little cautious on this point, considering that 76% of the business leader are viewing that they will have only cash to match up with the cash outflow requirement for next 3 months. Certainly, it is a red zone from the liquidity perspective and going concern perspective, and also it will certainly have implication from the impairment perspective as well. 85% of the respondent felt that RBI stimulus package is so far not adequate for the Indian companies. 55% of the business leader felt that it will take 6 to 12 months for demands to come back to normal. I would say this is more realistic in the Indian context, and hopefully, if it happens, then it will be boon to Indian economy. If we get to the recovery path in 6 months, then certainly we will get to the normalized phase closer to September timeframe. And 56%, 51% of the business leaders have not examined the cash tax optimization as a strategy, and 72% have felt that uh, gaining market share or more efficient way of working are the opportunity from the COVID-19 disruption. So which means that a lot of business leaders are actually thinking that COVID-19, of course, has impacted their business, but certainly in the time to come, they see a lot of gains coming out of the entire situation which is created. There could be a lot of assets which have gone down in their valuation. Certainly, we see that a lot of mergers and acquisition activity may kick up in coming time, because some of the valuations are almost on the rock bottom stage. The valuation of various companies have come down, and there are certainly a lot of companies which are pretty much uh, in a zone where it has hit their bottom, and certainly there is opportunity for the buying company to take over such companies. And certainly a lot of people are thinking in terms of, in the time to come, how do we manage the shift in the consumer demand. And they are also thinking of modifying their business prospects, business segment. We were discussing with some of the guys where they said that they are investing more on the online components rather than presently working on offline. So certainly a lot of things will undergo change. Some industry will certainly gain out of COVID-19, and it is upon a particular company to work upon in terms of what all things they can take to their advantage in the current environment. We have also discussed with a lot of CFOs in terms of understanding their agenda for the time to come. What we have seen is they have all created cash war room, which is pretty much working on the working capital and cash conversion, working out on the critical service payment and differing cash deferral opportunity and things like that. So certainly they are working towards what can be deferred in terms of the cash outflow, considering the cash is king. A lot of people are actually looking at some of these as an opportunity to defer the payment and somehow manage the only to pay the critical payments and conserve cash to the extent possible in the current environment. Forex and treasury management, hedge position, etc. is certainly the need of our people are trying to take the advantage of the situation, because they think that ultimately if somebody has taken hedge position, then the company will certainly get benefited. It will have lesser volatility in their income statement, and certainly that will help a lot of companies to work upon such aspects. And then certainly work from home has created a lot of internal control challenges with respect to receipt and payment, because all the internal control mechanism is devised considering that everybody is coming to office and there is a complete maker checker process in place. But now all of that has been dismantled. So companies are also working towards how to manage the internal control. And certainly it has implications from auditing and accounting perspective as well. The forecasting and planning, especially the cash flow management, considering the fact that all the companies are working on the cash war room basis, forecasting cash flow projections on the short term, medium term, and long term is certainly a work which is done by all the companies at this moment. And all the companies are actually working out on the cost efficiency. Book closure is certainly a need of ours as we are speaking. A lot of companies are working on their year-end closure. So certainly this will all have a serious and critical implication from accounting and auditing perspective. From next perspective, which is 2 to 12 months, the finance function reorganization is on the card. Internal control mechanism has to be strengthened. Forecasting and planning has to be strengthened. Digital ways of training and enablement is also considered. Reassessing the entire risk framework, plan for recovery and taking the corrective action, and certainly cost efficiency, bringing it, the cost optimization will be certainly a thing which we think will have implication on a long-term basis. What we have also seen from the business operation perspective is the workforce perspective, the bandwidth has been an issue. Managing contingent and hourly workforce, maintaining the security protocol due to remote access, difficulty in executing the processes involving manual tasks, and cyber security is also become a challenge. We have seen a lot of companies where the email has come by imposter, treating themselves to be the CFO and giving instruction to the people to make the payment, etc. And later on, it was found that it came from a fictitious email ID. So all of these things have also gone up. And every company is working towards strengthening their cyber security system so that they can strengthen their security platform and avoid any kind of cyber compromises. I think I have briefly touched upon on the financing and working capital, and from the company's perspective, uh, uh, everybody is looking for leverage lines of credit, and differing on the closing of the debt deal. IPO certainly has been pushed out for some time due to market uncertainty, but I think my M&A has taken a beating, but I think it is expected to rebound very quickly. And liquidity management and working capital management is certainly need of ours. So all the companies are anyway working very closely on that, and trying to work out a model which will help them to manage their working capital better, and at the end of the day save the cash outflow to the extent possible. From the customer perspective, the companies are evaluating the collectibility of accounts receivable. The clients, especially in the impacted sectors like airline, hotels, and entertainment, if they are asking for concessions, and if the companies have the customer base which is mostly the clients in the impacted sector, then it will certainly have implication on the expected credit loss perspective. Certainly, it will have an accounting and auditing implication. Media and entertainment, the all the theaters, amusement parks are on a complete shutdown. So all of this will have a lot of implication from the company perspective. The other area, which is the regulatory compliance, I will talk about the regulatory compliances and all the concessions given by the government of India in a while, and I will take up a special consideration with respect to that. On the investor communication, the companies are coming forward and giving guidances in terms of what is going to be the future outlook, and how they are managing their current systems and processes. So certainly we have seen some investor communication coming forth even before the financial statements are coming out. We have seen and we have discussed with a lot of companies, the board communication has increased, and especially what we are seeing is close to about most of the CFOs that we have discussed. They have created a board communication plan on a bi-weekly basis, wherein they communicate the update to the board on a bi-weekly basis, and or even shorter if there are any challenges that the company is facing. So audit committee is also asking for the report on the prospective and business continuity changes, etc. So from that perspective, I think on the board communication perspective, we are seeing a lot of activities in various companies which are in the listed environment perspective. Ashok ji, you have any further question on that? Okay.
Hello. Yeah. Sir, can you tell us the key impact areas in accounting and what challenges will be faced in future?
Sure, and I think this is the meaty part of the today's session, and this is these are the areas which are very close to heart of the accounting and auditing fraternity. So certainly, this is a very pertinent question, and this is the primary reason we are here assembled today to discuss the impact and implication of COVID-19. So certain areas which I think will have implication from the financial statement impact perspective is the asset impairment, revenue recognition, government grants, the financial instruments, the accounting estimates, lease accounting, other consideration like these DTA, ESOP, lease accounting, and certainly going concern are some of the areas which will have greater degree of impact on the from the financial reporting and financial accounting and auditing perspective. So certainly this is an area which will attract most of the attention in time to come. So I will start with the area which is most critical, and most of the companies are grappling with this particular aspect, which is on the asset impairment. So as we all know, India's 36 requires entity to assess at the end of period whether there is any impairment of any entity's non-financial asset, and the goodwill and impairment of the asset and indefinite having intangible having the indefinite useful life. The standard requires an annual impairment test to be done, and for the other class of the assets, the standard requires the entity to require to assess at each reporting date whether there is any indication of the impairment from that perspective, and the measurement of that is where the recoverable amount is estimated based on value in use and the consideration of accounting estimates, and any future forecast cash flow would reflect the management best estimate, and what are the significant challenges with respect to forecasting. And since remaining useful life of the asset such as goodwill is long term, and entity should consider just the short term effect, and especially for the long term effect. So there are various challenges which I've seen companies are grappling with, and I will talk about each of those challenges in a while. And an institute has also come up with a detailed guidance in terms of what are the key accounting and auditing consideration from the COVID-19 perspective, and which clearly summarizes and also talks about what all things the companies need to take care while working on the uh, current year's financial statement. So that is certainly which is a very useful publication, and I think all of you would have already gone through that from the perspective of accounting and auditing consideration. In this particular slide, what we have done is we have compiled the guidance given by Institute of Chartered Accountants, especially on how the impairment testing has to be done in the COVID-19 scenario, which is primarily come up post January 2020. From the impairment guidance perspective, the company has to look at the fair value less cost of sales, and then look at the value in use, and if the recoverable amount, the higher of the two will be considered to be the recoverable amount, and if recoverable amount is greater than the carrying value, then the company is expected to recognize the impairment. But if the recoverable amount is greater than the carrying amount, then there will be no impairment. So it all depends on while testing at the CGU level, what do we see is fair value less cost to sell, and what is the value in use, and higher of the two will be considered to be recoverable amount. If the recoverable amount is greater than the carrying value, then no impairment. If recoverable amount is less than the carrying value, then the company is expected to recognize the impairment, and that is pretty much the guidance in the accounting standard. But I will also talk about some of the challenges which companies are facing. So companies are expected to test the impairment if there are any indicators of the impairment, which is temporary ceasing of the operations, immediate decline in demand, disruption in supply chains, any legal issues or working capital, and any funding issues. So and trade with the companies which are companies or the countries which are significantly affected by COVID-19. So these are some of the indicators which are mentioned by Institute of Chartered Accountant in their publication, and certainly we need to take into cognizance from while we are testing for impairment. So certainly this, we need to follow the guidance which has come up from the institute, especially on COVID-19 scenario. So, what are some of the key takeaways from the guidance by the valuation bodies and regulators? So, what we have done is we have compiled the guidance issued by Institute of Chartered Accountant, and various other valuation guidance, and there they have mentioned there is a significant valuation uncertainty due to the impact of COVID-19. There are multiple methods and scenarios possible. Could be a base case scenario, the optimistic scenario, the pessimistic scenario for the cash flows, and are to be considered by management to arrive at the value. So it is anybody's guess at this moment, as compared to in the past where there was a complete certainty in terms of how the cash flow will emerge. But at this moment, it is anybody's guess, and accordingly, they said that the companies have to evaluate basis different scenarios that the companies are facing today, and what is they also came as a guidance is that despite volatility, quoted prices in the active market will be still relevant for the listed security. So we cannot disregard uh, the 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 quoted price of a listed security, considering there was initially a discussion in the accounting fraternity, considering that the share price drop is pretty short term in nature, and especially in Indian context, it reached its bottom close to around 31st March, and people were debating to the fact that whether we should take the quoted price as the indicative of the valuation. So institute has also come up with the guidance that despite having the volatility in the market, the quoted price of the active market is still the relevant for the listed security, and the companies are also expected to make the assumptions which are made basis the best estimate of the events that are likely to occur. So it has to be realistic in terms of whatever the management is coming up with the estimation of the cash flow that is expected in the current environment. So as we have seen, what companies are doing, and what is recommended by the valuation body is that discounted cash flow model is preferred model, and it has to be done at asset or cash generating unit level. And we need to look at uh, the recovery path that is expected out of the discounted cash flow post COVID scenario. And remember, in the initial discussion I talked about the V curve, U curve, and L curve. So again, it has relevance while we are doing the impairment assessment of the company. So from that perspective, if the company is considering V curve, which is pretty much shown in the black uh, line, versus U curve, which is little bit darker gray, versus a light gray environment, which takes the longer period of time, which is considered to be L curve. So the company has to look at all the possible scenario of recovery, whether it will follow U curve, V curve, or L curve, and we'll have to come up with the perspective of what is going to be the expected scenario for that particular company. And if the company is uncertain about scenario, then it has to work out each of the scenario and the probability of occurrence of each of those scenarios to come up with the expected discounted cash flow. And in time of extreme certainty, DCF provides more robust basis of analysis for valuation for comparable multiple basis as compared to comparable multiple basis or asset valuation method. And it permits the valuation considering various scenarios and also considers the extreme uncertainty in short and medium term. So, and which is why most of the valuation at this moment recommend to discounted cash flow method in order to assess the impairment of a particular asset or impairment at a particular cash generating unit or at the CGU level. And the comparable multiple has various limitation, etc. So which is why in the current environment, the generally the DCF method is preferred from the impairment assessment perspective. Now we have also we will talk about some of the challenges which we see, which companies are actually grappling with while doing the impairment assessment, and which is pretty much due to the challenges that each of these companies are facing. First of all, the situation is very evolving. It is unprecedented. Nobody has seen similar situation in at least last 200 years. So there is no historical trend or record which can be used for working out any kind of the assessment from the cash flow perspective, which can be used, which are available from historical data. So it has to be pretty much very relevant for the organization to look at. All the academic researchers have shown that pandemic often have significant short-term impact and more uncertain long-term impact on the GDP growth or the growth of the company itself. So certainly is a challenging time, and also this creates some bit of challenge for the companies to work out the possible cash flow scenario to come up with the discounted cash flow. There is a difficulty in assessing the long-term impact in the pandemic, because as we discussed, it is anybody's guess how the recovery and will take place and what will be the shape of recovery, whether it will be U curve, V curve, or L curve, or a W curve. It is certainly anybody's guess at this moment. And the impact of the financial stimulus, it will depend if a company is in the industry for which government has given lot of fiscal stimulus or liquidity provisioning, etc., then how these financial supports uh, are committed by the government, then how does the company consider that from the cash flow perspective. And also there are multiple expected path of recovery, and there is even a likelihood of recession, not in India, but certainly the companies which are working in multiple economy and multiple geography. For them, this problem further multiplies, because each of the countries recovery path will be different, and accordingly it will have certain implication. Let's say if the company has a foreign operation, and it has come up due to acquisition, and ultimately there is a goodwill lying in the books on the consolidated basis towards the acquisition of foreign operations, then the challenge of assessing the goodwill impairment will be different from what is available in India, and accordingly it will have certain implication from the impairment perspective. The traditional approach has been, and which is what all companies follow, is that they work on single cash flow projections or a most likely cash flow method. But in this time of uncertainty, we are seeing a lot of companies have taken the multiple cash flows projections with the weighted probability of each cash flow projection, and they have baked in the uncertainty to reflect the different probability and weighted projections. So they have certainly worked on all these aspects, considering the description, the disruption in the economy is unprecedented, and nobody has ever seen that. So it poses a problem for the company and the management of the company to come, first of all, come up with the cash flow projections. It poses certainly a problem for valuers, uh, and 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 also it poses a problem for the auditor in terms of what should they rely on, and what is the most reliable expected cash flow model, what are the weights which are given for the cash flow projection, whether it is realistic or most likely. So a lot of questions and challenges which I think everybody in the accounting fraternity is going through, right from the preparer of the financial statement to the auditor of financial statement, and ultimately once the financial statement is published, it will certainly create even problem for the readers of financial statement in this unprecedented and highly uncertain scenario that we are facing. So uh, and certainly it is a lot of work for all the chartered accountant community at this given point in time.
So, sir, one question here. Sir, considering the uncertainty, like how many projections you think a company should make?
So I guess what we have seen is the companies, there is no one answer to this. It really depends upon as a matter of fact, which particular industry you are in. Certainly industry will also will be material to consider the possible scenarios which are going to be impacting each of those companies, and then what is the state of the company in terms of what is the uh, order book, which is pretty much certain. If there is little bit of uncertainty, then you will have multiple scenario. But if, let's say, 70% of your revenue is the order is booked, and your customer base is not in the impacted industry, then obviously it will not have any implication for that kind of a company. So certainly it has a lot of implication from that perspective, but at the end of the day, what we have seen, at the minimum people are working with at least three scenarios, and it can multiply depending upon which particular sector or which particular industry that company belongs to.
Thank you, sir.
So moving ahead, the other big challenge which I am seeing a lot of companies facing is the implication, especially while we are doing the DCF method, which is discounted cash flow. What would be the suitable discount rate is also a pertinent question, and it also impacts the DCF valuation as well. So there is always, considering in the current scenario, the discount rate would vary depending upon the industry, and also will also impact depending upon the very company in a specific. And first of all, the risk-free rate has to be adjusted downwards given the repo rate has declined. Increase in market volatility is expected to push the cost market risk premium. So there is a downward revision in the risk-free rate, upward revision in the market risk premium, and given the beta are backward looking and does not reflect the current volatility correctly, one may consider mid to higher end of the range, depending upon which industry the company is working on, and alpha is to be based on the company's specific factors. So in that sense, I would see that uh, the finding out the appropriate discount rate is also a key question which most of the companies and auditors and valuers are debating at this moment. But given the scenario, it is important to have the holistic assessment of the discount rate in the context of the subject industry, and also the risk with respect to prospective financial information, and the expectation of the falling risk-free rate and the cost of debt will not automatically translate into lower cost of capital. And as per the special guidelines by IPEV, greater uncertainty may translate into greater risk, which will translate into greater required rate of return, and which will translate into lower asset value. So that is the criteria, and which is guided by IPEV from the valuation perspective. So certainly, I think this is an area which is subject to a lot of judgment into consideration. The company, I will just summarize, company will have to look at the multiple scenarios. Companies will also have to work out what and assign weight to each of those scenarios. The company will also need to look at what is the appropriate discount rate, and also consider the risk-free rate going down and market risk premium going upwards, and for consideration of beta, mid to higher end has to be considered as compared to lower to mid, from the perspective of coming up with the appropriate discount rate. So these are some of the areas which I think company and the valuers have to assess from the perspective of the impairment assessment. And I will just move on further on the disclosure bit, in terms of given the uncertainty, and in general, what I would say is that this is an era, whenever you have an era of uncertain time, uh, the mantra is disclose, disclose, and disclose. So which means that more disclosures made will always be better and beneficial. And accordingly, management should consider even disclosing key assumptions and sensitivity, which is considered while considering the valuation and change in method and incorporating certain consequential changes on the variable used to measure the recoverable amount. So certainly all that has been taken into consideration from the perspective of the asset impairment. I would expect that all the companies should also disclose that in their financial statement, so that readers of financial statement are also able to understand the philosophy of management and how and why uh, the assessment of impairment is robust and how it has impacted the assessment of impairment of a particular company, of particular asset, or a particular CGU in a particular company. Moving ahead, I will now talk about the revenue recognition and inventory, which is also a very key area for all the companies at this moment. And collectability of the consideration is also very important in the current environment. And as we know, if the company's accounts receivable is more in the area where the companies are in the industry which is impacted more, let's say in the real estate, or in the airline sector, or in the hotel and recreation, then obviously the collectability of the consideration will also need to be assessed while recognizing the revenue. The estimation of variable consideration is also to be done, given the scenario that in future the companies may not be able to achieve the target which will derive the variable consideration. In that case, the company needs to re-estimate the likely scenario and what will be the most likely variable consideration in order to assess the revenue it has to recognize. And depending upon that, maybe higher discount or lesser discount or any other form of variable consideration is to be considered. The impact on the future contracts is also to be assessed in light of the current scenario and in light of the current uncertain scenario, whether how will impact even the future contracts which are signed or unsigned, how will impact the business, and how will it impact the revenue per se. And then we have seen a lot of companies which are in distress are asking for their uh, companies to do the modification or cancellation of the existing contract of services, which will impact the companies which are providing these services or goods to consider the modification or cancellation of the existing revenue contract. And if the companies, some companies are taking an instance that COVID scenario is act of God, and it has implication from the force majeure clause perspective, and some of the companies have actually invoked the force majeure clause and said that they are not bound to uh, and they are not obligated to follow the contract which is already signed. So all of those will also have implication from the revenue recognition perspective. The impact on the inventory valuation is also very significant, especially if there is a bill and hold transaction. So it is already billed, but the goods are still lying with the company which is supplying. So in the era of lockdown, how will that happen? The obsolescence of inventory is another area which has to be dealt from the accounting and auditing perspective, and also decline in value of the inventory for non-fulfillment of the sale or purchase order will also have an implication. So a lot of challenges in the inventory valuation itself, and from the auditor perspective, it has a challenge on the physical inventory count, because in the current environment, the physical inventory count is not possible. So the auditors will have to take into cognizance of the rollback procedure in the current environment, and its efficacy has to be ascertained depending upon the company and also the industry as such. So I guess uh, we have seen a lot of challenging scenario in revenue recognition and inventory as well. I will now move on to the other area, which is very significantly impacting or impacted in the current scenario in the balance sheet of various companies, which is primarily the financial instruments itself, and considering that in certain company scenario, it will have a greater challenge and greater implication for a particular company perspective. And the first one is the impact due to fair value measurement. So certainly the financial instruments is one such area which is impacted the most, apart from impairment, because again, this is also an area which deals with valuation, and in the current environment, the valuation is such that it is under serious challenges and threats, and it will have certainly a lot of challenges in the year-end consideration for the preparation of financial statement in the current environments. We have already discussed about the fact that the institute has already given its guidance in terms of the fair valuation of listed securities, wherein it says that the market valuation is to be considered to be the fair value. So there is no two way about it, but the challenges are there in valuation of the unlisted equity instruments. How do we value that? And in light of the fact that whatever valuation was done in the past, especially the cash flow projection, etc., using DCF, would undergo a severe change in the current environment, and getting first of all that data and analytics will have itself a challenge, and then determining its fair value is another area which will have a lot of challenges. There is another area which is area of focus, which is the fair value disclosure of the instrument, not at the which are not at in primarily on which are primarily level 2 or level 3 securities. So certainly they will have implication from the accounting of those instruments from that perspective. We have already discussed about the fact that it will have impact on the discounting rate, and we have, I think, gone into greater detail what are the factors to be considered from the working out the impact on the discount rates. So certainly the company has to look into greater details all those consideration. The effective interest rate to be considered for newer contracts is also to be considered. What will be the most likely effective interest rate, And certainly there are challenges with respect to disclosures, and entity need to consider making the related disclosure about reasonability to expect to influence these decisions, and primarily the user of the general purpose and financial statement would make on the basis of financial instruments, and users should understand the basis for selecting the assumption. So and there is a lot of interest rate risk, etc., which has undergone a change, and the company will also require under the IFRS Ind AS 109 all the sensitivity are also required to be disclosed. So from that perspective, the companies are expected to give greater amount of disclosure to the users of financial statement. The other area which has got another significant impact within the area of financial instruments is the expected credit loss assessment itself. So entity need to evaluate the likelihood of occurrence of event, which is the higher risk of bad debt. Management may also want to review their provision matrix of the expected rate, resegmentation of the loan portfolio for the group of receivable, and especially if the receivable group or are belonging to a particular industry, then that also has to be understood from that perspective. And then the individual and collective assessment of loan and receivable, and the contract assessment and extension of the payment term, etc., the request if comes, then that all will have serious implication on the expected credit loss assessment or the ECL assessment. And company will also need to disclose any changes in ECL methodology in order to better estimate the impact of outbreak in accordance with the requirement of Ind AS 109. So entity should disclose the changes in estimation technique if at all, and company is also required to provide qualitative and quantitative disclosure to enable user of the financial statement to understand the effect of credit risk on amount, timing, and uncertainty of the cash flow. So certainly within the financial instrument area, ECL provisioning is certainly one area which will impact almost all the companies, unless the company is having all the customer base which are least impacted. Moving ahead, still continuing on the financial instruments, the breach of loan covenant may trigger the repayment on demand and may impact current and non-current classification. So all of that is certainly an area of concern for the management. In the current scenario, there could be many companies who have breached the loan covenant requirement, considering the unprecedented and uncertain economic scenario. And if the company is badly struck, then it may have implication from the liquidity perspective as well. And then the other area is that changes in terms of evaluation of the modification or extinguishment of accounting, for example, change in the long term, etc., will also be impacted from the financial instrument perspective. And evaluation whether presentation of volatility impact on the fair valuation could be treated as exceptional item. So a lot of debate in the area of financial instruments. Then the other area which is very important from the financial instruments perspective is the hedge accounting. So what has happened is company may have taken hedge position and may have taken the hedge accounting option, but what has happened is this outbreak has severely impacted the probability, may have impacted the probability of hedge forecast transaction itself occurring. So if the forecasted transaction is no longer highly probable, but is still expected to occur, so this is a situation where it is no longer highly probable but is still expected to occur. If that be the case, then hedge accounting should be discontinued prospectively, and accumulated gain or loss in other comprehensive income will remain recognized separate and as equity until the forecasted transaction occur. However, if the forecasted transaction is no longer expected to occur and at the same point in time, hedge uh, then the hedge accounting is to be discontinued prospectively, and accumulated gain or loss in OCI should be reclassified to profit and loss immediately. So depending upon how the hedged forecasted transaction occurrence is expected, it will have serious implication in the P&L volatility, put on the other comprehensive income may be required to be plowed back to profit and loss account. So depending upon whether it is a scenario where the forecasted transaction is no longer highly probable to occur but is still expected to occur, there will be a different accounting treatment vis-a-vis if the forecasted transaction is no longer expected to occur. Then in that case, whatever has been recognized in OCA will get plot back to the income statement, and certainly if that happens in a particular given company scenario, then it will certainly impact uh, the uh, the hedge accounting and also the income statement of that particular company which is in such a distress scenario. Although I would say that not many companies follow the hedge accounting, and not many company will be within the state where the expected transaction is no longer expected to occur. It is only in a very is a small proportion we expect that to happen. But I thought I must bring to your notice that while you are doing the accounting or auditing, if that's a kind of situation occurs, then how the accounting will be impacted in that particular scenario. And I guess now I will move on from the financial instruments to leasing, and this is another area which has impacted most of the companies, and which is what we are seeing in the market, because a lot of companies have actually taken into consideration that uh, retail segment is many of the cases have gone to the lessor, saying that whatever the rentals they are expected to give for the lockdown period is act of God, and accordingly they are not expected to make any payment during the lockdown scenario. So we have seen a lot of media reports on this, and if that happens, then whether it should follow the modification accounting from lesser perspective, or whether it should be just adjusted to income statement, is certainly an area of concern for from the lessor perspective. And there is a guidance which has come up from Institute International Accounting Standard Board, which allows both the treatments, either to follow the modification accounting or to follow it as a one-time exemption. But in India's, I guess we will still have to follow the India's guidance on lease, and if the company is already under India's, then in that case, considering the fact that this is the first year when the companies are accounting under India's 116, it will certainly have some bit of implication for that company. And also from the lesser perspective, there is a need to evaluate the lease asset, whether there is a degree of impairment or not. So certainly this is one area which has implication from the accounting perspective. Moving ahead, certainly the critical accounting estimate is again an area which is very important from the management and auditor's perspective. We need to test the recoverability of deferred tax asset under standard of income tax, and then we also need to assess the remaining useful life of residual value of property, plant and equipment, intangible asset, and right of use asset, and accordingly it will have implication, accounting implication. The estimation and measurement of employee benefit and recognition of share-based payment expenses, these are some of the other critical accounting estimates that has to be relooked from the perspective, and provision for liabilities on onerous contract and provision for penalties that company is liable for the result of unforeseen delay to the stipulated delivery deadline will also have to be considered, whether COVID-19 outbreak has constituted any force majeure issue. So all of that will have implication from the accounting perspective. And
Sir,
I will, sorry, absolutely.
yeah, sir, can I ask you a question?
Sure, sure.
Yeah, yeah. Sir, don't you think that providing the uncertainties regarding the projections and other thing, the chances of manipulations will increase?
No, so what is recommended for the management is to look at the most likely scenario and work out the different possible scenario and work out the probability of occurrence of those events. So certainly, I know that it is not a question of manipulation, but it is more a question of ability to do that. So many a times, in due to uncertainty, people may not have the ability to do that as opposed to manipulation. I would think that given scenario, the uncertainty, if there is a slightest of doubt, then in that case, company should look at multiple scenario and also look at the probability of occurrence of each of those, and work around with that, as opposed to treating this as an opportunity to manipulate. And I've what wherever we are working, we have seen that there is no such intention. It is more a challenge to get to the right set of cash flow modeling and right set of probability of occurrence of different scenario.
Right.
Some of the other consideration which are relevant in the current environment is whether company is preparing financial statement for different reporting periods, and we have seen that in a scenario where the company is part of any companies which is multinational organization, and for group reporting purpose, their reporting is year end. For Indian reporting purpose, their year end is 31st March, and they have already reported their group numbers, and suddenly COVID outbreak has happened, which is a Q1 scenario from group reporting perspective, whereas it is year end accounting from the Indian reporting perspective. So this all having different outcome, and it may have an adjusting event for one reporting date, but may not have the same for the other reporting period. So it creates more complication for the subsidiaries of multinational corporations in India. and there is also an evaluation required for borrowing cost suspension or the government grant, considering that government is coming up with a lot of SOPs, whether the government grant accounting has to be applied for the uh, favor given by the government or not, is certainly has to be understood and thought through from that perspective. Um, Now I am moving to another area which is causing a lot of issues in terms of accounting and reporting, which is the area of going concern. So certainly this is an or accounting and auditing area wherein, as we all know, if in general the accounts are prepared basis the going concern, and if the going concern itself is under a question, then it will require different method of accounting. So as we all know, in this one requires management while preparing the financial statement to make an assessment of an entity's ability to continue as going concern. And a standard also requires that all available information about future, which is at least but not limited to 12 months from the end of the reporting period, should be taken into account. So in this scenario, what we have seen is people are looking at longer period to justify this, but there is a need also to prove that why, if the company was earlier considering 12 months uh, as the foreseeable future, why now company is looking at 18 months or 3 years as the foreseeable future in the era of uncertainty. So all of that is also a question of judgment, and disclosure of significant judgment is also required, where assessment of existence of any material uncertainty is a significant judgment. And management should also take into consideration the existing anticipated effect of the outbreak of the entity's activity in its assessment of the appropriateness of the use of going concern. And also management should consider all the information about the future which it has obtained after the reporting date. So certainly it is an area which we think and which we are at this moment uh, dealing with various companies, is the going concern is most challenging assessment in the given scenario. And as I mentioned about the fact that, if the company has taken loan and its debt covenant has been breached, whether it will have an implication of returning back the amount to the company from its where it has borrowed, then certainly it will have a going concern question popped up. So all of that consideration has to be looked at on a holistic basis. And as Ashokji also mentioned, the fact that, there are different possible scenarios possible. There are different outcomes possible. There could be different weight given for different outcome, and all of that is an area of judgment, and certainly it will have a serious implication on the assessment to be done by the company on a going concern basis. And accordingly, company has to disclose the given the unpredictability of the potential impact of the outbreak, that may be material uncertainty, and if it casts significant doubt in company's ability to operate under the going concern basis. So certainly it will have serious implication from auditor as well as the management perspective. I will just now move ahead from this topic to the topic of events after reporting date. For the companies that are affected or expected to be impacted by the outbreak, or by measures taken by the critical judgment and evaluation that management needs to make is whether if so, what event is the series of event that provides the evidence of the condition that existed at the end of the reporting period of the entity's activity and the assets and liability. And accordingly, if it is an existing event or if it is non-adjusting event, that will be defined by the judgment made by the company. And if that be the case, then if the events are non-adjusting but impacts these non-adjusting events are material, then entity is required to disclose the nature of the event. And in the early stage of outbreak, the high level of uncertainty due to unpredictability of the outcome of this disease may itself make it difficult to estimate the financial effect of this outbreak. But if the estimate cannot be made, in that case, the entity is required to disclose this fact. So certainly, it is an area which will have serious implication from the perspective, whether to report event after reporting date or not.
Uh, Thank you for explaining us the key impact areas in accounting and the challenges which we're gonna face. Sir, can you now throw some light on the disclosure requirements?
Sure. So as I said, Ashokji, in past is that this is in the era of uncertainty. The mantra is disclose, disclose, disclose. So in this environment, the more the disclosure, the better it is for the company, and the better it is for the regulators, and the better it is for the readers of financial statements, so that everybody understands the logic which has gone into the consideration. And accordingly, financial statement disclosure requirement has to be taken very seriously. An entity needs to disclose all the additional disclosure requirement in the financial statement. If wherever there is a decline in value of the asset, then the entity should be determining whether it is adjusting, non-adjusting, and the entity should disclose such fact. Wherever disclosures are impracticable, they disclose the possible impact, the disclosure of sensitivity of carrying amount, the assumptions and estimates, and any other underlying calculation made are also expected to be disclosed. All the nature of assumption and estimation of uncertainty is also required to be disclosed. And maybe what we will do is, for the purpose of the giving an disclosure how it is looking in the current environment, I've just pulled out some companies' financials which are available in the public domain. So you can see that the company like Infosys and Wipro, who have already reported their disclosures, how does it look, and what estimates have they done, what assumptions that they have done, and what is their disclosure in terms of sensitivity analysis, etc. So you can see that Infosys mentioning that COVID-19 has not material impact basis the estimates that they have done. They have also talked about the possible future uncertainty in the global economic conditions due to pandemic, internal, external sources of information that they have looked at, the economic forecast, census estimates, and then the market estimates, and the future performance of the group and its implication is something that they talked about. And also they talked about the sensitivity analysis, and so on and so forth. So you can see that a lot of these disclosures have come up on account of COVID-19. And similarly, Wipro also talked about how its revenue is negatively impacted due to COVID environment, and what is the expected impact due to service discontinuity, and ability for employee to work from home, and contract cancellation, ramp up, down, ramp up. So all of that disclosure, we have picked up few pointers only. Maybe readers of the financial statement can actually go into the full length of the financial. What I will try to give you is some bit of glimpse of some of the disclosures made by some of the leading companies in the current environment. And also you can see the other company which is in this, which is Implication. So they mentioned that they are also not having any material impact. I have picked up one Chinese company, which is China Mobile, and how they are reporting and what are they talking about the impact of COVID-19, what is the forward impact that they are doing, and they are also mentioning that the revenue, there is complete degrowth, and they are also expecting decline caused by the decrease in the sale on handset and IoT devices, etc. And what are some of the challenges the company is facing with respect to business transformation, upgrade, or 5G related cost, and what they are planning in terms of. They said that in the future, the company's focus will be to find new revenue sources and also cut down on the cost. So these are some of the key areas or the guidance that they are giving to readers of the financial statement in India and abroad, in terms of how the I they interesting, very detailed impact of the impact of COVID. They have given the whatever has been downfall in revenue. So they mentioned by each areas, by service line and segment, what is the decline in revenue. So where they are mentioning that they lost revenue about 600 million US dollars, and there is a complete EBITDA impact of about 430 million dollars due to bad debt, due to voluntary corporate action taken primarily to protect the compensate the frontline employees and contractors, and complete shutdown in production facility, etc., and incremental costs that they have incurred for their operation. So this is another very detailed guidance with disclosure made by by AT&T on how the COVID-19 has impacted the accounting and the finance operations of the company.
Thank you so much, sir, for explaining us the challenges in the disclosure. Sir, can you now explain us some considerations to be taken during audit?
Sure, and maybe you can appreciate some of these points I have already mentioned while picking up these particular points specific to let's say going concern or specific to impairment assessment. But what I will do is I will give a broad overview on auditing consideration, uh, and then I will go into specific areas as well. So certainly, audit teams are facing difficulty in determining the appropriateness of the management assumptions and estimate. And to your point, Ashokji, which you asked, that this could lead to somebody taking advantage of the current uncertain environment, and how does auditor take into consideration that it has followed the due process. So I think what all the companies are doing, especially all the auditors, there is, as I in the beginning I mentioned that Institute of Chartered Accountant has come up with a separate publication, which is the guidelines on the auditing and accounting implication of COVID-19. So most of the companies and the auditors are actually taking the ICA guidelines as a key guideline to look at the auditing and accounting consideration. And the whatever I am just talking today is pretty much, just replicating what has been guided by the Institute of Chartered Accountants of India. And I will recommend all of you to go through, if you have not gone through already. It's a very summarized and very high quality publication to guide the auditors as well as the management as to how to deal with COVID-19 accounting and audit scenario. Um, there is a wide impact is for the auditor for the purpose of minimizing the concern and investment. And if there is operations which are outside India, then it is further gets complicated. And then if the auditors or the group of auditors may find the following consideration helpful. First of all, the identify the impacted audits, categorize the audit by material, but not significant, material, and significant and immaterial, and consider wider implication of the audit report, give more consideration and have a holistic view on going concern basis, wider auditing effect areas, especially the impairment accounting, the inventory valuation. It could be even revenue recognition or leases, or for that matter, even financial instrument, and ensure that all the respective disclosures are made and all the key audit matters are taken into consideration. Discuss the amending the reporting timelines. Also consider if the auditor is not convinced with the uh, estimates done by the management, then putting the emphasis of matter with respect to uncertainty, especially in line with the industry that company is in, and also the company in specific. If that be the case, then auditor may consider putting emphasis on matter, especially on the uncertainty of the valuation, etc. The auditor is also required to consider the alternative activity to demonstrate the review and evaluate the component team where originally visited by the group auditor was planned. So all of that will have a serious implication where company is acting as a group auditor. So uh, and then the other area which I think is the challenge is performing the inventory count. Now auditor could not go on 31st March to do the inventory count, and then making the assumptions and estimates, doing the roll forward procedure, etc. Whenever the market the lockdown will be over. So all of that is certainly a key area of challenge. How the audit strategies to be made, and look at uh, both the physical count and as well as the valuation of inventory. Um, and certainly, as I mentioned in my earlier part of deliberation, going concern and subsequent event is a very key area, and team has to work on but with the specific companies about the cash crunch scenario and all the concerns that should be looked at from the going concern area, and which I think we have deliberated in greater detail about the background, follow that. The other area which has got lot of compromised in this current scenario is the internal control over financial reporting. A lot of people are working from home. How do you, the company or auditor, ensure that the teams are considering how to perform the control testing remotely, and then companies assessing the potential impact of the changes in ICFR environment, changes in how the management is executing control due to work from home protocol, and considering the need to modify the management disclosure with respect to internal control over financial reporting, and how do they address these challenges and changes. And if there is any ICOFR changes, then companies having to consider mitigating control for the controls which the control testing could not be performed, could be the cycle count as part of the quarter or year end process, as the case may be. So certainly it's a lot more challenging time for auditors, and considering that even audit is to be performed remotely for the companies in the given scenario.
Yeah, certainly, sir. Seems like a very tough route for the auditors ahead. So, can you also guide us on the regulatory initiatives and the reporting challenges?
Yeah, certainly. I mean, all these regulatory concerns and perspective. One thing is that has relaxed the filing of quarterly result by 45 days and annual result by 1 month. So certainly a breather for the company's management as well as auditors. So now companies have 45 days and 30 days additional to work around the year-end reporting. SEBI has also extended regulatory filings in the companies for 31st March again by 1 month. The that year the was applicable for the year end 31st March 2020. It has been deferred by an year, so certainly a breather for auditing fraternity. Otherwise, we were supposed to follow the new company's auditor report order, and which required the auditor to perform a lot of additional procedures which were almost not possible in the lockdown scenario. So there's a relaxation in timelines for holding the board meeting, and also there's a relaxation in terms of if the independent director did not hold even one meeting in last year, the same should not be seen as violation in financial year 20. No additional fee shall be charged for late filing due to moratorium period from 1st April to 30th September 20. Additional 6 months is given to newly incorporated companies for following declaration for the commencement of business, which is presently 6 months. So, certainly SEBI and MCA has given due consideration for the companies to and auditors, and eased out certain reporting requirements, or eased out the timelines of filing in order to help companies to work in this given challenging scenario. What I was of what are the different filings and what is the change from due date and what is the extended date, etc. So the compliance certification on shares transfer facility, which was due on 30th April, is now due on May 31st. The statement of investor complaints, which was required by 21st April, is now required by 15th of May. Secretarial compliance report, which was required by May 30th, is now required by June 30th. Corporate governance report is extended by 1 month. Now the deadline is May 15. Shareholding pattern is the due date was April 21. Now it is May 15. The financial results and financial results for NCDs, NCPRS, and commercial papers, all which is dealt by Regulation 33, 52, 1 and 52, 2. The deadline, which was May 15 and May 30th respectively, has moved to and extended to 30th June. So certainly a lot of extension, relaxation timelines for most of the companies. And has come up with a lot of regulatory and regulatory comprehensive package to mitigate the negative effect of COVID-19, revive growth and bring uh, it has done it in two branches. So expanding the liquidity in the system and normalcy has brought down the CRR repo rate, reinforcing the monetary transmission for a smooth credit force, so reverse repo rate and extension of Basel III framework, improving the functioning of financial market, long-term repo operations and offshore rupee NDF has been simplified. These are to give liquidity to the banking sector, and for the borrowing community, what RBI has done is it has eased out the financial stress caused by COVID by giving the moratorium period for debt repayment, and it has also gave relaxation on the asset classification norm. Simultaneously, there was uh, package given for NBFC, etc., in a separate guidance which was issued by RBI in early April itself. So a lot of work is done by the central bank to ease out the the liquidity for and a lot of easement for the borrower as well. So certainly we think a lot more are expected to come in time to come to further give relaxation to both borrowers and the banking sector, and also the mutual fund, etc., which are pretty much in red at this point in time. So we expect more to come, although I think RBI has given the required easement on a timely basis. Moving ahead, there are a few concerns given on the tax front. So interest rate has been reduced for delayed payment. So reduced payment is now 9% for payments made between 20th March and 30th June. No late fee and penalty and prosecution. The extension of deadline of Vivad se Vishwas to 30th from 30th June and with no additional 10% amount. CBDT has issued a specific order to relief in respect of lower or nil TDS or and new stamp duty rates to be effective from 1st April 2020, now to be effective from 1st of July. So again, this has been deferred by 3 months. So there's a relaxation in investment, deposit and payment and on construction, etc., under different section. So certainly, what we understand is further representation is made on non-levy of interest for delayed payment and cash flow assistance by expediting the receipt of refund from the tax authority. So a lot of work is being done by CBDT in easing out the direct tax concessions, and a lot of policy announcement there. On indirect tax bit, similar concessions in terms of waiver of the interest of the late fee again, which are returns which are due in March, April, May 2020 or 30th June. So from that perspective, if the taxpayer with the turnover of less than 5%, then 100% waiver. If the taxpayer with the turnover more than 5 crores, then 100% waiver of late fee, no interest for 15 days, and thereafter interest of 9%. The amount payable under Sabka Vishwas scheme can now be paid up till 30th June. A restriction to cumulatively apply September 20 for tax period of Feb to August. GST exemption extended till 31st March 2021. And then the timeline of meeting export obligation so by 6 months. So in short, lot of policy swaps, policy announcements, and we can expect some more on that. And these are some of the summary of what we wanted to cover on the government regulatory changes which has come, and I think we are pretty much on time. In terms of just to summarize what we discussed so far, we also discussed what are all the macroeconomic changes which are happening due to COVID, what are the accounting challenges and accounting implications, what are the different disclosure or additional disclosures required for COVID-19, and then also we also looked at some of the auditing challenges which audit fraternities is facing in the current environment, and what are the things to watch out. And we also taken you and gave you some guidance which may not be available at present in public domain as well. So a lot of guidance and summarization is done on whatever the regulatory changes and SOPs given by the government. So in short, I think I would just summarize some companies which are taking COVID as an opportunity. They are thinking that this is the era to work on cost optimization, look at omni-channel, look at being virtual, look at innovation, look at innovative product technology, going digital. So I guess that's a new economic definition of COVID, which for the optimistic people, everybody is taking this as a positive sign to work on more agile basis and ultimately come as a successful company in the current environment. So with that, I would say that we should work on given in the current scenario and continue to spread the positivity everywhere around. Ashokji, you are on mute, which is why we can't hear you.
Thank you so much, Dr. Devesh Prakashji, for your valuable time and giving such a rich and learning session on COVID-19 implications. And thank you all for attending the session.
Thanks, Ashokji.
With this, we conclude today's session, and thank you, everyone. Stay home, stay safe. Thank you all.
and spread positivity.
Yeah. Okay, sir. Thanks.